We need to talk about Japan because there is a lot going on in their financial markets right now. Last week, Japan's Prime Minister Sanae Takachi called a snap election. She wants to consolidate power in parliament so she can push through an economic stimulus package and cut Japan's national sales tax, which is currently 10%. And the bond market hated it. Rates on the Japanese 40-year bond pushed past 4% for the first time ever. The problem is Japan's debt to GDP ratio is already 230%. For context, the US is 110%. So to enact a huge tax cut like this at the same time you want to increase public spending just piles on more debt, and investors want to be compensated for that extra risk. And the government debt is so huge that even a small rise in interest rates is a huge amount of additional interest payments for Japan. So then the conversation turns to, if rates are rising in the market, what are other ways that we can keep them down and keep the government interest payments down? Well, one way of doing that could be for the Bank of Japan, Japan's equivalent of the Federal Reserve, to buy Japanese government debt in the market. Interest rates are set by supply and demand, and if you introduce a huge amount of new demand into the market, that will push rates down. And this is where the US comes in. Japan is a large holder of US debt, $1.2 trillion, more than any other country. But if the Bank of Japan is now going to need cash to buy their own government debt, they might be a seller of US treasuries to raise cash, or they might buy fewer treasuries in the future. Either way, that is taking demand for US treasuries out of the market. And since interest rates are set by supply and demand, that will push US interest rates up. Japan stops buying, less demand. The US needs to pay a higher rate to attract new demand. And that is exactly what happened last week. US rates went up on the expectation that Japan might be buying fewer treasuries in the future. This can all get a bit complicated, so if you have any questions, leave them in the comments. Now, at the same time this has all been going on, Japan's currency, the yen, has been on a multi-year slide against the dollar because of monetary and fiscal concerns, and is now at a multi-decade low. Look at this chart, really stunning. The yen is also at record lows against the euro and the Swiss franc. Japan is so endlessly fascinating. I love talking about it. If you like this video, subscribe for more. Now, why does this matter? Well, Japan imports a lot of goods, especially oil. Now, the international oil trade is denominated in dollars. So when you have the yen weakening so dramatically against the dollar, that makes oil a lot more expensive. Oil is the lifeblood of an economy, and more expensive oil creates inflation, which of course means higher interest rates and higher borrowing costs for the Japanese government, exactly what they are trying to avoid. So you have two forces pushing interest rates up. You have inflationary pressures from a weak currency and oil, and you have investors demanding a higher rate for what they see as unchecked fiscal policy. Let's face it, it is not a good time to be a Japanese central banker. And this is where it starts to get really interesting. So Japan, as I said, is a huge holder of US treasuries, and Japanese stability is absolutely in America's best interest. Last week, the Federal Reserve Bank of New York made a very unusual move, which was to perform a rate check on the yen. A rate check is an early signal that the bank would be buying yen. It is very unusual for a Federal Reserve Bank to engage in currency trading like that. The last time it happened was in 2011, actually also with the yen, after the Fukushima earthquake. Now, the Fed has not purchased any yen as of this moment, but the rate check sent a powerful signal to the market that they are ready to intervene in the yen if necessary, if only to stop any Japanese issues from pushing US rates higher. And the market has reacted accordingly. The yen was near 160 to the dollar before the rate check, and as of this moment, it's a tick under 154. Will the psychology be enough, or will the Fed actually have to intervene in this market? We will find out more this week. What is the takeaway? Well, there's a lot of talk about deglobalizing industry right now, but it is much harder to deglobalize our financial system. What happens in Japan can make waves in America, and people do not even understand why. And that's why I'm here.